Hey traders, welcome back to the channel. Today we are diving into moving averages, one of the simplest, most practical ways to read trend and cut through market noise. In the next few minutes, I will explain what moving averages are and we're going to learn all about them. The topics of this video are as follows. First, we will talk about the meaning of moving averages and we will teach you how they are calculated. Second, we will talk about different types of moving averages. And third, we will learn how to use them or run them on MetaTrader platforms. Lastly, we will talk about the different possible strategies for moving averages. So let's move forward. So, what are moving averages? Moving averages are one of the most popular tools in trading because they help us smooth out price action and see the overall trend. Instead of looking at every single candle, a moving average takes a group of past prices, adds them up, and then divides by the number of candles. The result is a single line on the chart that makes trend easier to spot. So let's talk about what are different MA modes. First, simple moving average or SMA is basically the average price of an asset over a certain number of candles. For example, a 50 period SMA takes the last 50 closing prices, adds them up and divides by 50. On the chart, it looks like a smooth line that helps you see the trend more clearly and filters out the small price moves. Second, the exponential moving average or EMA works a lot like the simple moving average, but with one big difference. It gives more weight to the most recent prices. That means the EMA reacts faster when the market is changing direction. For example, if the price suddenly jumps, the EMA will move quicker than the SMA. Traders often prefer the EMA when they want to catch trends earlier, while the SMA is better if you want a smoother, slower line. Third, the smooth moving average or SMMA is a type of moving average that takes into account a much longer period of price data. Unlike the simple moving average, which only looks at a fixed number of candles, the smooth version keeps all the previous data in the calculation but reduces its weight over time. The result is an even smoother line on the chart, which filters out a lot of noise. It reacts more slowly than both the SMA and EMA, so it's mainly used to spot the long term rather than quick entries and exits. 4. Lastly, the linear weighted moving average or LWMA is another version of moving average, but this one gives the highest weight to the most recent price and then decreases the weight step by step for older prices. That makes the LWMA even more sensitive than the EMA. In other words, it reacts really fast when price changes. Some traders like it for catching quick moves, but the downside is that it can also give more false signals in choppy markets. So let's see the difference between them in the next slide. As you can see here in this chart, we have four different moving averages and the period is 100 candles. So now let's talk about how to run this indicator on MetaTrader platforms. So now I will show you how you can insert moving average indicator on the chart. You can click here and this tab insert and then you choose indicators. Then you go to the trend tabs and you can choose moving averages. Here we have some different parameters that I will talk about them. The first one is period, that you can choose it, the number of candles it will consider for calculating the average. The other one is the shift. The shift moves the moving average value forward. For example, if I set it to 0, you can see that the moving average ends here exactly on the last candle on the market, the open candle. But if I set it to 5, you can see that it moves forward 5 candles, as you can see here. And the other one is the method, as we talked before, simple, exponential, smooth, and linear weighted. You can choose any of them based on your trading style. You can see that it is now smoother when we change it to exponential. You can choose on which price you want to apply it. You can choose close, open, high, low, the medium price. Typical price is high, low, close, the sum of them, and divide by 3, and weighted close, which is high, low, close, close. Close has more weight and it divides by 4. In here, in this line, we choose the style. Style has color. You can choose different colors. I will choose more light color, like, for example, something like pink. And I will adjust the line width. You can see, you can change it easily. Moving averages aren't just for spotting trends. You can also use them to create simple trading strategies. Let's go through a few of the most common ones. First, the single moving average strategy. This is the easiest one. If the price is above the moving average, you only look for buys. If it's below, you look for sells. It works best with longer averages like the 100 or 200 period because those highlight the big trend. Next, the double moving average crossover. This strategy uses two moving averages, usually a fast one like the 9 or 20 period and a slow one like the 50 or 200. When the fast line crosses above the slow line, that's a buy signal. When it crosses below, that's a sell signal. This is simple and popular because it helps you catch new trends early. Third, the golden cross and death cross. This is a longer term version of the crossover strategy. The golden cross happens when the 50 SMA crosses above the 200 SMA, which many traders see as a strong bullish signal. A death cross is the opposite, the 50 dropping below the 200, and is seen as bearish. The signals don't happen often, but when they do, they can mark big trend shifts. Finally, pullbacks. Pullbacks to the moving average. In this strategy, you wait for the market to trend in one direction. Then to a key moving average like the 20 or 50 EMA. If the price bounces from the MA and continues in the trend, that's your entry. The approach is powerful because you're trading with the trend, not against it. Of course, moving averages aren't perfect. They lag beyond price and they can give false signals in sideways markets. That's why it's smart to combine them with other tools like support and resistance, RSI or MACD for confirmation. So those are some of the most common moving average strategies: single MA, crossover, golden cross, and death cross, and pullbacks. Simple to learn and great foundation to build your trading around. For conclusion, I have to say moving averages are one of the best tools that traders use every day for getting positions, enter the market, or get out of the market. Please watch this video and enjoy it. Don't forget to leave a comment or like this video. Follow us for more videos. Thank you.